Global equity markets tumbled in June as investors feared the risk of a recession due to central banks tightening monetary policy in much of the world to fight inflation. The MSCI World and S&P 500 indices both plunged more than 8%, while the MSCI Emerging Market Index ended the month 7% lower. Traditional havens and other asset classes didn't provide much shelter from the equity storm. As an example, the Bloomberg Global Aggregate Bond Index fell 3% and commodity prices also dropped from their recent highs. The winning trade for the month seems to have been to sit long US dollar cash. The Bloomberg Dollar Spot Index, which measures the performance of the US dollar relative to its peers, being up significantly. We do have quite a bit of dollar exposure in the fund, but we don't like cash as an asset class. So inflation prints across the globe continued to surprise on the upside, which was the driver of these asset classes underperforming. So our balanced fund is exposed to the asset classes mentioned, and therefore also was down 5% in June. While this is not a very pleasing result, it is in line with what one would expect in these markets. Our tactical asset allocation model, which aims to capture short-term dislocations and mispricings in the market, has signaled some shifts. Most noteworthy would be the shift on the currency side. In relation to the dollar, we shifted up from neutral to a moderate overweight on the Japanese yen, while our stance on the rand has been downgraded from a strong overweight to now just a moderate overweight. We do remain firm on our strongly positive view on SA equities and SA bonds, and we remain moderately positive also on SA property. We're moderately underweighting US equities. It's a trade which obviously has played out quite nicely this year, and we are neutral on global emerging markets and European equities. So halfway through the year, we've seen two waves of sell-offs in global markets. The first wave was a top-heavy global equity market sell-off in line with the rise in commodity prices on the back of the Russia-Ukraine conflict. South African assets remained relatively unfazed, with the natural commodity hedges coming through nicely during that sell-off. During the second sell-off, however, SA wasn't quite as lucky, with global inflation persistently printing higher than expected, but now also a broad-based risk of hurting bond yields and equity prices alike, driven by more recessionary fears. Basically, asset classes fell in lockstep. So what these market declines highlight to us is the benefit of not putting all your eggs into one basket, even when you have a bullish view on an individual asset class. The importance of measured tilts comes to light when you look at a global equity market down around 20% and an SA equity market down only 10% year to date. So the US Federal Reserve raised the target range for the federal fund rate by 75 basis points. That was just in June, and it comes after already 50 bips hike earlier this year, taking the new range to 1.5 to 1.75%. So this marks the largest upward move since 1994. The latest projections made by the FOMC members indicate that they still have more room to go. The median projection of the midpoint of the range now suggests 3.4% at the end of the year. So there's another 175 bips projected by the FOMC, and the market is actually pricing in line with this. We don't quite agree with that. The fact that demand-driven inflation is not that pronounced. Inflation right now remains more supply-side driven. And inflation expectations, for example, if you look at US break-even inflation, inflation expectations remain very anchored, confirming our position of actually being long SA bonds, taking more duration in the income space, betting on South African assets to recover, and benefiting from the high real rates which are currently priced into markets. So as mentioned, long SA equities, long SA bonds, moderately positive on the rand, neutral on global EM, and slightly bearish on US equities. As always, we remain guided by insight and informed by science, trusting the data we process to get a logical, refined view across global asset classes.